Welcome to the Veripax Investment Training Series, where in this module we're going to talk about one of my favorite topics, structured notes. I'm Jerry Versaput, President and Principal Investment Advisor for Veripax Financial Management. Structured notes are used a lot in the institutional arena in things like pension funds and endowments, but you don't see them much in the retail world, which is where you and I live. There's probably several reasons for that, but in my view, those reasons mostly do not include doing what's best for the client. I'll talk a little bit about why structured notes aren't used more widely for non-institutional accounts, and I may be a little more aggressive about it than normal because I think this is a very important topic and an area where much of the financial community is failing. As always, nothing in this presentation should be taken as investment advice. If it sounds like advice, it's not. It's just my opinion. If you're not a current client of mine, you may have never even heard of a structured note, so we'll start with just describing briefly what a structured note is. Where do you get one? Well, the structured notes are offered by all of the major global banks. They issue them just like bonds. And in fact, a structured note is very similar to a bond. Technically, these structured notes are senior notes, which means they're have a little less credit risk than the bank's bonds. But with notes and bonds, you're lending the bank your money. So you give the bank your money for a while, the bank promises to give you a certain interest rate, and then at the end they give you your money back. Same thing with a structured note. In the event of a bankruptcy, because these are senior notes, senior note holders always get paid before the bank's bond holders. So again, a simple note would just pay you an interest rate over a period of time. And a great example would be a treasury note, or if on a mortgage note where you're borrowing from the bank, you give the bank a simple interest rate. What makes the structured note different is that the return is more interesting and maybe fulfills a different role in your portfolio than just fixed income. So the bank will start with a note and then build a structure around that in order to entice a few more investors to lend the bank their money. So very simple explanation is that structured notes are like any other notes or bonds, except that the return is more interesting and in most cases, it's a little more complex. I want to address one of the questions that I get a lot just right up front, and that's why do banks sell these structured notes in the first place? And the reason is that banks need constant flows of liquidity. So they need constant cash flowing through their bank just to keep things running smoothly. And that's why they sell bonds every single month, and that's why they sell notes. So to get a few extra people to lend them money each month, they create these notes that have a more attractive return than just a simple interest rate. Again, that fulfills a different role in a portfolio. It gets a few more investors to lend the bank their money. So a lot of times I get asked, well, how does the bank make money on these notes? And they're not trying to make money on the notes themselves. If they did, that would put them in direct competition with their clients, and they don't want that. The banks simply want access to your capital in order to use it for banking stuff. Maybe they loan it out as credit card debt, maybe they leverage it up and loan it out. Whatever the banks do with it, they need your capital every month, and so they create bonds and notes and try to entice you to lend them money. For you business types, the cost of selling these bonds and structured notes is simply the bank's cost of capital. So they want to keep the cost to the bank to, let's call it 4% a year. That's just a guess. That would be their cost of borrowing your money, and then they want to go out and hopefully make a better return by doing banking stuff. The total market for structured notes is about $40 to $50 billion a year. That could be a lot of money in some contexts. In terms of the banking industry, that's actually pretty small. So they're really just looking at some incremental dollars by selling structured notes. So the thing to take away from this is that banks need your capital. They raise that in multiple ways, whether they sell bonds, sometimes they borrow from other banks, and in some cases they create these structured notes and sell those to you. They're not trying to make money off the notes themselves. They're just trying to borrow money at some cost of capital to the bank. Hopefully now that you know what a structured note is, you realize that they're really not all that exotic. It's just another form of lending money to a bank. And yet, despite that fact, they tend to get a lot of bad press for some reason. So I pulled a few quotes off the internet here that you can take a look at. This last quote really caught my eye. Bernie Madoff's Ponzi scheme was small potatoes compared to this. I came across that quote, that was a few years ago, and I thought, wait a minute, these are senior debt obligations of global banks. There's no Ponzi scheme going on here, so why on earth would somebody write something like this? And I've got a few theories about why they have so much bad press. So, number one, and by the way, clients do forward me articles when they run across these, and they always ask me, hey, well, what about this? What I've found is that a lot of the articles are actually complaining about how structured notes were marketed in the past. 10 or 20 years ago, like many investments, structured notes tended to carry a pretty attractive commission to salespeople. And like anything that has an attractive commission, it tended to be over-marketed. So I haven't seen that since I've been using them, because in a lot of cases the extra fees and commissions have been wrung out of investments in the last several years. But in the past they were over-marketed, and there's still articles written about that. Second reason here is that many advisors aren't allowed to use them, whether it's the platform they're on isn't allowed to hold them, or maybe their compliance department just doesn't want to dig through a prospectus. For whatever reason, there's advisors that can't use them, and I'm guessing that then they will badmouth them just to make sure that clients don't ask about them. The third reason here, maybe a little more cynical, but I think there are advisors who are just too lazy to really dig into this stuff. Structured notes are more complex than a simple stock or a simple bond, and so it takes a little bit of reading and some study. And there are some advisors that just refuse to be educated. So I'll just leave it at that. Ultimately, we do have to remember not all structured notes are a match to every portfolio, just like any investment. And I see a lot of structured notes that I wouldn't touch, particularly for a retail account. Maybe they have a use in some pension fund or something like that. I'm not sure why people would buy them. So not every structured note is a good one, but that doesn't make them all bad. And so I just wanted to address a few of these things right up front. Okay, enough with the preamble. Let's take a look at what some of these notes look like. First one I'll talk about here is a pretty simple one. It's called a contingency note. And where a bond would pay you simple interest rate that isn't contingent on anything, on a contingency note, the yield is actually contingent on usually the performance of a stock index. As long as the stock index doesn't fall by a certain amount, then the note will continue to pay interest, and that interest is always higher than what you could get if you didn't have this contingency. So essentially it mixes a little bit of stock market risk with the normal credit risk that all notes and bonds would have. The barrier, as long as the index doesn't fall below a certain barrier, that barrier is oftentimes maybe 60%, sometimes 50% of the value that the index was at when the note was issued. So these can have pretty substantial barriers, but as long as they stay above the barrier, then the note pays its interest rate. A steepener note is a little more complicated. It's going to have a variable yield that's based on the steepness of the yield curve. Now what that means is just that we're going to take a look at 30-year interest rates, subtract that rate from or subtract the 2-year interest rates, so take the difference between 30-year and 2-year interest rates, and then multiply that by something. As I make this recording, the yield curve right now is very flat, so there's only about a 1% difference between the 30-year and 2-year rates. But in the notes that I'm seeing today, that gets multiplied by 10, so we're right back up to a 10% yield. And often these notes will have a cap on the interest rate that's somewhere around 10%. And the reason why they use the yield curve steepness is simply because interest rates contracts are so easy to trade. A step-up note kind of looks like a stair step. So it's going to do a few years at one interest rate, and then a few years later the interest rate will bump up to another one, and then maybe a few years after that it'll bump a little higher again. Pretty simple. Just the interest rate continues to step up over time. All three of these first notes are income notes, so I would use these to boost the income of a portfolio. The last one, what I'm calling an accelerated return note, this would be an example of a stock replacement. So I'm using this note to replace stocks. And these will always be based on an underlying group of stocks or an index. And typically they'll last 5 or 6 years. So at the end of 5 years, they'll take a look at how the S&P 500 performed, for example, and we'll get some type of leveraged upside. So one I'm using right now has 150% participation, which means whatever the return, positive return is at the end of 5 years, we get 1.5 times that return. But what if the stock index doesn't go up over the 5 years? Well, as long as it doesn't go below a certain barrier, and that barrier can be different on different notes, then we get all of our money back. So we have downside protection, leveraged upside. How do we get that? Well, we have to commit our money for a certain period of time. Even though these notes can be sold on any day, if we want to realize the full benefit, we have to keep them until expiration. So what I really want to get out of this is that structured notes can come in almost an unlimited variety. And a lot of people that want to badmouth structured notes will pick one note that they don't like, and then they'll use that as a proxy for all structured notes. But you can vary just a ton of parameters on these. And in fact, a lot of times when I do a note for my practice, I'll have a note customize one just for my practice. So that way I can control exactly where I want the risks to be. I want to show a real-world example of one of the notes that I currently use in my practice. This one is issued by Credit Suisse Bank, and it's a 5-year note based on the S&P 500. So just as a reference point, if we owned an index fund or a mutual fund that invested in the S&P 500, if the index went up over that 5 years, we would make money, and obviously if it went down, we would lose money. In the case of this note, if the index is higher, at expiration, we would get a return that is 1.57 times the return of the S&P 500. So we get significant leverage on the upside by committing to 5 years. And most people, if they're going to invest in stocks, they have a longer time horizon. It should be at least 5 years. So by allowing the bank to use our money for 5 years, the bank is able to give us leveraged upside. But what happens if the index is lower? Well, in the case of this note, if it's anywhere between 0% and minus 50%, we get all of our money back. So again, by committing our capital for 5 years, the bank is able to protect the downside down to a 50% barrier. Question always comes up, yeah, but what if the market goes down more than 51%, which over 5 years, that would be significantly worse than anything that happened in the financial crisis. But if it did happen, we would then be sad because we would experience a 1-for-1 loss with the index. No better or no worse than having owned the index, minus the dividend that we didn't get, but we would still be sad. These notes cannot have, in the most case, they can't have unlimited market protection. But by committing our money for 5 years to the bank, and because of the bank's hedging techniques and the financial vehicles that they have at their disposal, they've figured out a way to give us leveraged upside and significant downside protection for really only 2 costs. The number one cost is that we're taking on some credit risk. This is Credit Suisse Bank. It's the second largest bank in Switzerland. I would say that the credit risk, the risk of Credit Suisse Bank going bankrupt is pretty small, but it does exist. And so we're taking on a little bit of credit risk and we're giving up the dividend. Again, for the S&P 500 and just in general, dividends have tended to be pretty small. So I would argue that that loss of a dividend is pretty minuscule compared to the benefits we're getting. Now, question comes up though, because it's 5 years, what happens 2 weeks after we buy it? Well, we don't know what the price will be. In general, if the market goes up, the price of the note will go up, but we won't see this full benefit until the day of expiration, and that's 5 years after we buy the note. I like pictures, so I want to give you one example of an income note. In this case, it's a contingency note that I'm using issued by Barclays. The underlying indices are the S&P 500, Russell 2000, and Euro Stoxx 50, which is the 50 largest traded stocks in Europe. It's things like Bayer and Siemens, big global companies. So this particular note pays a 10.5% yield, but that's going to be contingent on all three of these indices staying above a certain threshold. And that threshold is their 60% level. So as long as none of these three indices falls more than 40%, the note will continue to pay 10.5% interest every year. I think it makes quarterly payments. Now on these income notes, most of them are very, very lengthy, 10, 15 years sometimes. Most of the time they don't last that long because most of them can be called by the bank after a few years, meaning the bank can decide to redeem them. They might get tired of paying us 10.5%. In which case we take our 10.5% as long as we can, and then we have to, then we get our money back. But let's assume on this one it did last the full 10 years, and I'm just going to run a hypothetical stock simulation here with the S&P, Russell 2000, Euro Stoxx 50. Well, we can see the Russell 2000 didn't come close to that threshold, so we don't even need to look at that. The S&P 500 didn't come close to breaking our barrier. Well, actually it did come close, but it didn't quite do it, so we don't care about that one either. But oh no, the Euro Stoxx 50 did. So what happened during that time frame? Well, for about a year time here, and again this is all hypothetical, but for this 1 year, it simply didn't pay interest. So we didn't lose our principal, we just lost out on a year's worth of interest. Which means by the time this thing expired, we got 9 years worth of interest, or 95.5%. What I look for in these notes is I want to see a yield that is typically higher than what we would consider to be the long-term average for stocks, maybe 7 or 8%. I want to see a yield that's higher than that. And if I can get that yield and I don't have to depend on stocks to go up during that whole time, I just need them not to fall by a significant amount, well, then I think we end up coming out ahead at the end. Now, in the interim, just like a bond, the prices can move all over the place. In fact, when you own a 10.5% note, it's pretty likely you're not looking to sell that anytime soon. And so the price has to be estimated, and sometimes those estimates could be wildly off. But we don't care as long as we're making our yield, and we don't have any danger of losing principal unless one of these notes is below the threshold at expiration, which means they would have to be 40% lower, in this case 10 years from now, before we would be in danger of not getting our principal back. If that were the case, then I would probably be out of business and we would be trading bottled water. So in a lot of cases, the principal barrier accounts for cases that have never happened in the market before. So this is why I like income-based notes. The last thing I want to talk about is what's wrong with structured notes. In other words, if they're so great, why doesn't everyone use them? And in fact, while I've been putting together this presentation, I've been asking that question again myself. One of the problems is that they're complex, and a lot of advisors, they want to have a portfolio that they can just say, look, up, good, down, bad. If it gets any more complex than that, then it's just too much complexity. Also, some advisors are uncomfortable not knowing exactly how the bank is hedging their risks inside of these notes. I don't really view that as very important because the bank is taking on the risk of the hedge working. If that works for them, great. If it doesn't bother us at all. They're contractually obligated to honor the terms of the note. And if the hedge doesn't work for whatever reason, none of the banks issue enough of these notes for it to really harm the bank. So they have to pay us the terms of the note regardless. The third problem, though, is a real problem, particularly for advisors who work in large companies that have big compliance departments. A lot of times the compliance department wants to scrutinize every single note. It might look exactly like the note that was issued the month before, but it's still a month-long process to get it through compliance, and that's a lot of times just too much effort. So complexity can be a problem for some advisors. The other problem, which is one that I run into, and so does everybody that uses structured notes in the retail space, is that the price you see on your statement can be very unreliable. Structured notes are not intended to be traded every day. If a bank does a custom note for just my clients, we may never trade it after the date it's issued. And so how do we determine what the price is from day to day? Well, custodians like Fidelity will use a company that estimates the price, and they can't estimate the price of every single note every day, and so sometimes it goes a long time between updates. And they also tend to estimate the price low, and that's just for liability reasons. So the price that you see on statements can be pretty unreliable. You also don't get to realize the full benefit of a note until expiration. Now, these notes can be sold at any time. If you have an income note, it's paying a yield. If you have a stock replacement note and stocks go up, then it's likely that the note will go up by some amount, but you won't realize the full benefit of the note unless you hold it till expiration. Now, the fact that the prices are unreliable doesn't really matter. Well, if we're planning on holding these till expiration, then the interim price really doesn't matter, unless you're trying to track the progress of your portfolio day to day based on the final price, because these notes can really mess up the interim price of a portfolio. Now, I tend to think that tracking the progress of a portfolio simply based on the total price is a bad idea anyway, but it can be disconcerting to some investors. Bottom line, I think structured notes offer the opportunity to trade a large amount of risk, whether it's market risk or getting a higher yield, in exchange for a very small amount of credit risk. And since my job as an advisor is to essentially exchange different forms of risk to get a good return, structured notes are a very flexible vehicle to be able to do that. I'm tired of talking. You're probably tired of listening if you're still here. So with that, we'll call it a session. Thanks for watching.